Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Bertha Coombs, in today for Bob Pisani, who's celebrating his birthday. The major averages coming under serious pressure today as coronavirus fears flare up across the globe, with new confirmed cases surging outside of China, stoking fears of a potential long-term global slowdown. We've seen a flight to safety kicking in, gold at a 7-year high, and utilities hovering near records. So how do you protect your portfolio in the wake of these virus fears? I'm joined today by Dave Nadig. He's a director of research at ETF Database, and Todd Rosenbluth of CFRA Research. Dave, let's start with you. How do I protect myself in a situation like this? I see people going to gold. I see people going to the ultra short ETFs.
Sure. Yeah, so there are really two strategies here. One is to reposition and one is to hedge. So if you're looking to hedge, i.e. find the things that are going to go up when the market continues to go down, gold is obviously a good bet there. GLD is the one everybody knows. Right. There's some cheaper options out there, whether it's SGOL or BAR, both at around 17 basis points. That's a classic play here. I think it's more interesting, though, to think about other ways of staying in the market, to stay invested. And that can mean something as simple as looking at sectors of the market that may be a little immune to an ongoing concern about supply lines and all of that. I like the communications sector here. XLC is the spider tracking that. It's down quite a bit today.
Well, Facebook today moving into correction territory.
Exactly. So it's taken a big hit from Facebook. Google and Facebook together represent about 40% of the fund, so it's very concentrated. But you're also picking up Disney and Netflix and names that I think will be much more immune to a protracted downturn.
I'm sorry for jumping in.
Yeah,
there's safer ways of doing that at the sector level too, Dave.
Sure.
So there's utilities, XLU, you mentioned earlier, is holding its own. Real estate is another way of doing that. Or lower volatility oriented ETFs. So SPLV and USMV are two of the flagship products that are out there from Invesco and iShares, and they're more defensive, so you'll have heavier weightings in those more stable sectors. You'll still have some exposure to some of the more cyclical ones, so you can be in the market, as Dave mentioned earlier, but protect more of the downside as opposed to shifting to fixed income or shifting to ultra short with like a MINT product.
Are you guys not tempted here to get in? And I mean, you're getting in at a discount now on certainly something like the QQQs or the diamonds.
I think the question here is what shoes are going to drop that we don't know about yet. So clearly the market is finally reacting. I think a lot of us have been expecting this for a while. I think we got a little bit of Pollyanna out of earnings calls. We did not get a lot of talking down the first quarter, which I expected.
But they also didn't really know.
Right, that's my point. Is we don't
it was really
know,
early.
Right, we don't really know. I think I would not necessarily be looking at this as the opportunity to start buying high-flying tech stocks again, just because they're down a couple percent. Remember, these are the prices we just saw a couple weeks ago.
Right.
It may feel like a big correction right now, but really it's just a 2-week Groundhog Day.
And it's likely that there's going to be more selling, not for a prolonged period of time, but the market sells off this much. We'll maybe see a bounce back tomorrow as some rationalization comes in, but the market's likely to be choppy until we get greater clarity, as Dave talked about. Fourth quarter results were actually stronger than many people expected, but numbers were not part of this. We didn't expect this from a global perspective.
Would you be willing to short some of these major ETFs, or are you worried about, suddenly getting eaten alive in terms of a squeeze?
Well, certainly being short right now is be pure speculation. So if you're a long-term investor and you're using ETFs for asset allocation, you should have nothing to do with shorting. That's a tactical strategy. Obviously, in retrospect, the time to short was yesterday, not today. So I'm always a little reluctant. Yeah, I'm a little reluctant to either try to catch the falling knife and just catch the bottom of something, thinking you're going to get that timing right, or to believe that this is now, say, a 10-day downturn where there's a guaranteed win on the short. Both of those would be very speculative plays.
All right, let's switch gears here a minute. Let's move on and lift the veil on non-transparent ETFs. And if you're like me, you'd say, what in the world are those? American Century is widely expected to make history in the coming days as the first asset manager to launch one of these non-transparent ETFs. This follows a wave of approvals late last year for firms like T. Rowe Price, Fidelity, and Blue Tractor Group for their own strategies. Interest has clearly risen in this space, but how successful will it be? So, Todd, you're optimistic. Let's start off by explaining to people what this is. Is this sort of like a hybrid mutual fund ETF?
Yeah, so these are firms that tend to offer actively managed mutual fund strategies that are now getting the right to be able to launch ETF versions of those strategies. And I say versions, they're not going to necessarily be clones and a different share class, but there's firms, you mentioned T. Rowe Price or American Century, that have proven strategies, but instead of having to report their holdings on a daily basis, the way that every other ETF tends to do, they'll be able to disclose the holdings on a periodic basis, mask what's going on inside, let the active manager be able to buy and sell as they see more appropriately fit. And the question is whether or not there is demand. We at CFRA think there is demand for these products. There are folks that are looking and are fans of active management today, but don't have a lot of choices. So the demand for ETFs and the amount of money in these active equity ETFs is relatively small because the supply is relatively small too.
But if I'm a long-term investor, why would I want to do an ETF versus just the mutual fund? Why do I care if it only reports net asset value once a day if I'm not really trading?
So simply the tax efficiency is going to be significantly an advantage for ETF investors. So if you buy and hold in a mutual fund and hold it for the next 5 years, on an annual basis, you're still paying taxes on that for all the trading activity that's taking place in the mutual fund. Whereas an ETF, the trading that happens, the taxes are only when you make that trade yourself. So there's an advantage that's there.
But Dave, I can see how there's an advantage on the tax front. I can see how there's an advantage for the active managers because they pay fewer fees. But I'd be a little leery that it's so easy to get in and out of that I might be exposed to other folks using these and really reducing the sort of the returns.
Well, luckily the ETF structure keeps that from happening because when you buy shares of an ETF, you're buying them from somebody else. And you're not necessarily just buying them at the end of the day at sort of a net asset value. What that actually means is, unlike a mutual fund, your personal experience is uniquely yours. In a mutual fund, if a bunch of people head for the exits and it's been up a bunch, you could get hit with their tax bill.
But you could also get
their trading.
But you could also get a trader moving in and out of this.
Right, but a trader moving in and out won't affect you as a long-term holder at all because you're going to be trading those shares of the ETF on the open market. That's part of why I think these will have some initial traction for institutions that may be a big believer in a particular active strategy. This could be a really interesting way to be a little more aggressive in putting money in and out of those active strategies without having to wait for either a separately managed account window to open or for an end-of-day NAV.
And I would just add to it the active management component that doesn't exist for the triple Qs you mentioned earlier. The sell-off, there's likely active managers that are seeing this as a buying opportunity. If they believe that this is a short-term blip, they'd be able to act on your behalf to be able to pick up things that are selling off, whereas the index-based approach does not do that. And transparency or not, you're still able to use your skill to be able to buy things that are selling off on the cheap as the active manager.
Sure.
Very interesting. It's always good to have a new product. So turning back to today's big news, the coronavirus. Chinese stocks are getting swept up in the global sell-off, clearly. But overall, large cap China tech and healthcare names have actually held up better than you might have expected. Investors had been putting money back to work in emerging markets in recent weeks, according to analytical firm Lipper. Brendan Ahern joins us, and he's the CEO of KraneShares, which runs K-Web, which is widely viewed as the benchmark for Chinese internet stocks. That is an ETF as well. So Brendan, I was looking at it. K-Web is kind of mixed, although I would have thought that people would have been much more excited about web use in China, given the fact that everybody's been sitting at home with nothing to do.
I couldn't agree more, Bertha. You have this risk off where if you're quarantined at home in China, what are you doing? You're online gaming, online education, downloading content.
Yet NetEase has not been doing that well. IQIYI was doing pretty well. That's the Netflix of China.
It's very true that I think investors are doing a knee-jerk reaction, and they're just basically throwing away these great names that arguably are actually benefiting from this. I think what you're starting to see is in mainland China, equity markets are stabilizing. So I think that'll slowly come, and we'll see these names which are on sale being bought.
And one of the things I found very interesting is that Cure, that is the healthcare in China, is actually the best performer, up 10% this month. Names like Ping An that people may have heard of, they do the technology based and also offer other services. They are one of the big winners. And today the biggest winner is a supplier, I'm not sure how you pronounce this, Jiangsu Yue Medical.
So we're seeing within the portfolio, you're seeing companies that within the pharma, healthcare space, the companies geared to surgical mass,
right,
biotech, are the outperformers. Private hospitals are doing well. So healthcare is an area that has a little bit of a defensive, but as well as a offensive characteristic right now.
I would imagine that the government is spending a lot more on procuring supplies and also in terms of people coming into the hospital.
For sure, for healthcare, it's clearly a beneficiary. At the same time, we're seeing a lot of fiscal monetary policy to get the economy going. We know Q1 data is going to be very weak for China, but they're very geared to saying Q2, 3, 4 are going to more than make up for it. They're not changing their 2020 target. So that's where I think investors who are selling today, you could be regretting that very, very quickly.
But guys, do you trust the data out of China? That's always the question.
Well, I think you can trust some of it, but not all of it. The one that was most suspicious to me was the China PMI print we saw earlier. That number really is supposed to be a prediction of whether or not you think things are getting better or worse, right? So it's supposed to be a survey number. You would expect that number to have been 0, right? It's hard for me to imagine that a purchasing manager thinks that this is going to be a great quarter for China. I think we all know that's not going to be the case. Yet we saw a PMI print, I think, of 47.
Unless they're also banking on the fact that the government is going to step in with so much stimulus.
But that doesn't actually, the stimulus doesn't actually generate order flow for the purchasing managers that are supposed to be represented by the PMI. So that one number in particular, I was very skeptical of.
I would add just this is obviously China is a key area for certain sector-oriented ETFs and for local markets, but China is also the largest country in most emerging market ETFs. So you think of IEMG or VWO or EEM, China is by far the largest from within. South Korea is or is not, depending upon where it is. So it's important for investors to realize that they have exposure in a broader ETF portfolio than they perhaps realize.
And as we close it out, I just put the question to you. We are thinking this is a Q1 event, but what if this starts to really go well into the summer?
Yeah, I mean, so this is, we're seeing it from a U.S. perspective, whether it's going to hit first quarter numbers. But as you mentioned, there are global companies that are here trading in the United States that have exposure to this. So they're planning ahead for the rest of the year. We think that 2020 is going to be a volatile year to begin with, and that was before we saw what was going on in China.
Brendan, what are your thoughts?
I mean, the market's been due for a correction. Mainland China was up 35%. S&P was up 30%. The markets were due for a correction. Who would have thought Corona? Corona is very much affecting the elderly who have pre-existing conditions, and in China where we have a high rate of smoking and a respiratory element. More people were killed in the last weekend in car crashes than with Corona cumulatively. So I think this is a little bit of just the market is taking a correction. Who would have thought Corona? But I think markets for long-term investors are on sale.
Yeah, and just the unknowns of the Corona.
Yes, for sure.
Gentlemen, thank you so much. Brendan, Todd, Dave. That does it for us. This week's ETF Edge. I'm Bertha Coombs. My thanks to Dave, Todd, and Brendan for joining us. And thank you for watching. You can find all our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.